Hello friends, good morning and welcome to EduSat live lectures. Dear friends, as you know that we have started a series on financial accounting and today we are conducting the 7th lecture of this series. To discuss this topic with us, we have our subject expert Professor MC Sharma. Professor Sharma is Associate Professor in Shahid Bhagat Singh Evening College in University of Delhi. Without further ado, I would like to welcome sir to our studios and request him to start the lecture. Welcome sir.
Okay, thank you. Okay, dear audiences, friends, in the last two lectures, we discussed the first step of accounting process. That was recording business transactions in the book journal. So, journal is recording is the first book, journal is the first book and recording is the first step. And as you know, the whole process of accounting is based on the rules of debit and credit. Although in the last two lectures we have discussed a lot on that part, but again, I would like to revise these rules. These are called golden rules of debit and credit. Why golden rules? Because they are every time applicable. And these rules are based on the nature of accounts, that is personal, real and nominal. For personal accounts, it is debit the receiver and credit the giver. For real accounts, debit part comes in and credit part goes out. For nominal accounts, debit the expenditure or losses and credit the incomes and gains. In the last lecture, I also discussed the modern approach regarding rules of debit and credit. In this approach, we divide all accounts in 5 categories. One, the asset account, expenses account, liabilities accounts, income accounts and capital accounts. All these 5 accounts, out of this, asset, liability and capital may also be called balance sheet accounts, because capital, liabilities and assets are shown in the balance sheet of the firm. Income and expenditure accounts are also known as profit and loss account or income statement account. These are shown in profit and loss account. But for the purpose of the rules of debit and credit, we have classified them asset and expenses account in one category, because for the rules for them is debit the increase and credit the decrease. While for liabilities, income and capital accounts, we apply the rules debit the decrease and credit the increase. So, if we remember all these rules of debit and credit, we may not face the difficulty in recording of business transaction, and this is the very core part. After this first step, we have to go into the second step, or the second important accounting book is known as ledger. Ledger is defined by Cooper, the book in which all transactions of a trader are recorded in a classified form is called ledger. The ledger contains in a summarized and classified form a permanent record of all business transactions in the form of various accounts posted or transferred to it from general journal and other books of original entries. So, all the business transactions after recording in journal are classified or transferred into a book known as the ledger. And this ledger contains summarized and classified record of all business transactions under the head of various accounts. So, this is also a very important book, and if we maintain this book, which almost considered compulsory, so we find some advantage. What advantages of maintaining ledger is? One is the details of all accounts is available at one place, that is known in a book or the journal. If as a owner of the business or as a manager of the business, you want to know the details of a particular account or transactions relating to a particular account. For example, you want to know during the year how much furniture was purchased, how much sold, how much depreciation was charged on it. So, just see the furniture account in the ledger and you will find all the records there. And this is a permanent record of all business transactions, because every business must maintain the ledger and must keep it also for future references. As you know, the accounts are very important, and sometimes whenever there is a dispute between the two parties, so accounting books could be presented in the court of law as an evidence. So, we must maintain this record. So, this is the permanent record, and all these accounts also show the balances. Balances are very important. For example, amount due from each debtor. We have sold goods to Mr. Ramlal, so Ramlal is a debtor, and on a particular date we want to know how much amount is receivable, how much amount is due from him to us. So, just see the debtor's ledger and Ramlal's account and you could find out that. Similarly, if we want to know how much amount is payable to the different creditors, we could check the creditor's account in creditor's ledger. Suppose Ashok and Sons is one of our supplier and creditor, and he has called us to settle his account. So, how much amount is payable to him? We will ask our accountant to present the Ashok and Sons ledger account, and by seeing that we could find out the balance, so how much is due to that party. Similarly, if we check the different asset account, different expenses account, we could find out the value of asset on a particular date, any other liability, amount spent on a particular item of expense. So, all these balances show the summary information. So, instead of going into the details of the many accounts, if we want the direct balance, we could just check the balance of that account. As we will see in this accounting process, after classification of business transactions, the next process is summarizing, and in summarizing the first step is preparing trial balance. We must know that it is very important that we cannot prepare a trial balance without preparing and balancing ledger accounts. So, this ledger helps in preparing trial balance. Now, we will discuss this traditional format. The ledger contains many accounts. If you buy any ledger accounting book from the market, you may find the two types of books. In one book, you will find this traditional format. On every page, these columns will be shown. At the top of the page, there will be the space to record the title of the account. Like if you are preparing Ram's account, so you have to write on the top of that page Ram's account, that is the title of account. And then if you are seeing this format, the whole page is divided into the two parts, left and right, and there are 4 columns on every side, every part. Left part, which is also called the debit side, it has the 4 column date, particulars, JF, that is journal folio, and amount. The similar columns are shown on the credit side, date, particulars, JF and amount. I have shown just few items here, and this ledger account is showing balance. This format, the traditional format, is also called the T format. Now, we are using in practical life, real life, the different format of ledger account, and this is the modern format. In this modern format, we have the date, only one column of date recording all date of all transactions, then only one column of the particulars, every detail will be recorded in this particular column, then one column JF, but we have the 2 columns of amount, debit amount and credit amount. So, whatever amount is to be debited to a particular account, that shall be recorded in debit amount column, and whatever amount is to be credited to a particular account, that amount will be recorded on the credit amount column. Then you are finding the last two columns. One column is showing debit and credit and balance. Basically, this debit and credit indicates the nature of balance, whether the balance is a debit balance or credit balance. Just for example, I have shown here the few transactions. The rupees 6,000 in the first row of the account, that is debited column. So, there is no any other transaction, it means this account has a debit balance of 6,000. On a next date, a transaction has been shown on credit side 4,000. So, now once the 4,000 rupees are credited, it means the previous balance 6,000 is reduced by 4,000 and now the final balance is 2,000. So, what is the advantage of this modern format? The advantage of this modern format is that with the every transaction we calculate the balance. While in the traditional format you are finding that we have to calculate balance after a certain time, a week, a fortnight, a month. Then we have to make total on both the sides and find the balancing figure, and then we have to record. So, if in between we want to calculate the balance of a particular account, we have to follow this process. So, in that way this modern format is better. As we know, accounting is an information system, and an efficient information system provides a clear information and timely information. So, this format provides all transactions in an account and also the balance every time. So, every time when we post or record any transaction in an account, we could find out its balance. Now, we shall discuss the classification of transactions, that is classifying process. This process is also called posting transactions. This is the second step in accounting process. In first step, business transactions are recorded in journal or in any other book of original entry. In the second step, we classify them into ledger. So, in this step, all entries recorded in journal are classified or transferred from journal or any other book of original entry to ledger. This classification process is done in such a way that all transactions relating to a particular item are collected at one place or called account. Like we created the furniture account, so all transactions during the accounting period shall be transferred from journal to ledger in furniture account. So, transactions relating to furniture shall be recorded in furniture account in the ledger. So, this classification process is basically classifying business transactions accounts wise. So, a person, management or any other party or owner can calculate the balance or any information relating to that account. When we start posting, so there are certain prior steps. What are these prior steps? Before starting posting from journal to ledger, we must open all the relevant accounts in the ledger accounting book with the respective head, that is the title of account or respective name. Like we want to post it entry which has the cash account debit to capital for the capital introduced by the owner. So, before posting into the ledger, we have to ensure that the cash account and capital account are already created in ledger. Only then we can post these transactions into ledger. Another thing which we need to keep in mind, that every account is opened on a separate page or folio or different page. So when we record the transactions, so every page, a specified page is allotted to a particular account, and in manual ledger books in the beginning you will find an index where you can index all your ledger accounts. Like Ramlal's account, in the index on R alphabet column you could write Ramlal's account and also his page number or ledger folio, so that whenever you want to make a posting into the ledger, just go to the index, check Ramlal's account exists on which page, and then go to that page and do necessary posting. Another very important part is that only one account is opened for one title or one person or one item of asset or one item of income or expense. Just for example, if you open two salaries accounts, then some transactions shall be posted in one salary account and some transactions shall be posted in another salary account. So that will create a confusion to know how much total salaries have been paid during the accounting year or accounting period. So this is very important that only one account should be opened in the ledger accounts, because when we are doing the manual accounts, such error may happen and may be confusing. While if you go for the computerized accounting, the Tally software which is commonly used, it will not accept a duplicate account. Suppose you have already created an account in the name of the Ramesh, you will not be able to create another account in the name of Ramesh. No duplicate entry the software accept. So there it is a checkpoint, but in manual we ourselves has to take care before creating the different ledger accounts. Okay. If it is already created, then new account should not be created. And to take precaution for that purpose, it is better to create the index. So you can check in the index whether one account is already created or not. So these are the prior steps. You must open a ledger account in the ledger on a particular page and it must be indexed. Now we come into the posting part. Posting from simple journal entry. We know in a simple journal entry, one account is debited and one account is credited. So how to make posting into the ledger from a simple entry or transfer an entry from journal to ledger? There are two basic rules. First is, posting will be made on the debit side of the account which is debited in journal entry. For example, the entry which I told you just now, the cash account debit to capital for capital introduced. So this is a simple entry because one account is debited and one account is credited. Now in this entry, cash account has been debited, cash account debit. So the posting into the cash account will be made on the debit side only, while the posting will be made on the credit side of the account which is credited in the journal entry. In this entry, the capital account has been credited, so the posting of this entry will be on the credit side of capital account. Now we shall discuss the rules in detail. While making posting on the debit side in traditional format or in the modern format, because the rules does not differ. First of all, we should enter the date of transaction in the dates column. In journal, we can check the date of transaction. So the same date should be recorded in ledger. Then record the name of the account which is credited in the journal entry in particulars column. So when we are making posting from this cash account debit to capital in the cash account on debit side, we have to record in particulars column capital account. So a cross account is mentioned here. Why a cross account? This is for the reference checking. If in cash account we record cash account word, so we cannot know this transaction has taken on account of which transaction, which party or which item. So, when we record in cash account debit side capital account, it means the debit side shows the receipt of some cash, the cash has been received on account of capital. So, this cross account explains the different items automatically. Then in the column JF, journal folio column in the ledger book, we shall record the journal folio number from which the transaction has been transferred. Then we shall record the ledger folio number in the journal. Why this ledger folio number in the journal against the account which has been made posted? Because as soon as we record in journal the ledger folio number against the particular account, it shows that the posting or of this entry or this account has already been made. So, once the LF is mentioned here, it means the transaction has been posted into the ledger. And in case for cross checking from either journal to ledger or ledger to journal, we can easily refer that particular page number from where the transaction has been transferred or posted. Then in the amount column, we record the amount of the transaction. So, in traditional format, these all 4 items will be mentioned on the debit side or on of the account. While in modern format, date only the one column in particular, that the only amount column differs. Otherwise, there is the common columns for date, particular and JF, journal folio. Similarly, when we are making posting on the credit side of a ledger account, while making posting on the credit side of an account, so we know that the credit side posting will be in the account which has been credited in the journal. If we take the example of cash account debit to capital, the posting in capital account shall be made on credit side. Posting procedure is the same, rules are the same. Enter the date of transaction in the date column, then record the name of the account in particular column which has been debited in journal entry. So, in this way a cross account is posted. Like in this entry in capital account, on the credit side we shall record by cash account or cash account on the credit side. So, by seeing the capital account, we could interpret it, we could know that the cash has been received on account of capital or capital has been introduced by the owner in the form of cash. Then we shall record the journal folio in the ledger and ledger folio in the journal. And then we shall record the amount on the credit side. In the modern format, the amount in the credit amount column. So, these are the rules for posting or transferring. But as we know that accounting is a practical subject, until we see some numericals or some example or illustrations, it may be difficult to understand, particularly for the beginners which are studying this process the first time. So, now I would like to explain this with the help of few transactions. Here I have taken the 4 transactions. First is business is started by Ram with cash rupees 20,000. Second transaction, goods purchased for cash rupees 5,000. Third transaction, goods sold to Hari rupees 6,000. And fourth transaction, furniture purchased rupees 5,000. When we want to record this in accounting books, we have to follow the accounting process. And the first step in the process is to record these transactions in journal. So, now you see the journal of these transactions. We have assumed the date on the 1st April. So, capital introduced by Mr. Ram. Same rules, the two accounts affected, cash account and Ram or Ram's capital account or capital account. Cash is a real account, rules, debit part comes in. So, cash is coming into the business or the firm. So, cash account has been debited, cash account debit to capital account or Ram's capital account. Second transaction, goods purchased for cash. Goods account we show in case of purchases account. It is a goods account is a real account, debit part comes in. So, purchase account debit to cash account, cash goes out, cash is also a real account. Then the next transaction, goods sold to Hari. Hari is a personal account and he is the receiver. So, debit the receiver, Hari's account has been debited to sales account, sales is income or goods goes out, rules will be same. Then the fourth transaction, that is the furniture purchased for cash, nothing is mentioned, means for cash. So, furniture account debit, furniture is a real account, debit part comes in into cash account. So, after recording the business transactions, we have to go into the second step in accounting process, that is today's topic, classifying or posting. So, if we check all these transactions, there is one cash account, another Ram's capital account, purchase account, Hari's account, furniture sales account, furniture account. So, in the ledger book, we have to create these accounts on a separate page. Cash account on a separate page, capital account on a separate, purchase account, Hari's account, sales account, furniture account. So, how will posting here, and after posting how it will be shown in ledger? First, we are seeing the Ram's capital account. I have shown it here in the traditional format, because normally for beginners this format is used. Later on you can switch over to the modern format. So, in this journal entry, Ram's capital account has been credited, therefore, posting will be made on the credit side and we have to record the cross account, that is the cash account. So, in the ledger we have to mention the dates in the date column, in particulars column, by cash account. This is traditional to write 2 on the debit side and by on the credit side. Although this is not compulsory nowadays, you are making posting on the credit side. So, you could simply write cash account on the credit side. If you do not write the by word, it does not make any difference, because we need to see the posting has been made on the correct side. So, that is more important instead of writing to and by. But if you are writing, you must write the correct. So, this is the posting on the Ram's capital account. Then we created cash account. In journal, we are finding the April 1 transaction, cash account has been debited and cross account other account is Ram's capital. So, you see in this cash account on the debit side, to Ram's capital account, amount has been recorded 20,000, date mentioned, JF we have not mentioned, we are not having the journal page number or folio number. So, but in real life you have to use it. Now, we are seeing another cash transaction on April 2, purchases account debit to cash. So, this transaction shall be posted into cash account on credit side and we have to mention by purchases account. Now, you see in this cash account on the credit side, date April 2, by purchases account, amount is 5,000. There is one more transaction of cash on 4th April, that is furniture purchased, furniture account debit to cash account. So, in cash account it will be posted on the credit side by furniture account. So, this is on the credit side by furniture account. Similarly, now we see the purchases account purchases account has been debited in the second entry. So, when we created purchase account, we have to make posting on the debit side. To cash account rupees 5,000 date has been mentioned. The next account, new account is Hari's account. In the third transaction, Hari's account has been debited. It means the posting will be made in Hari's account on the debit side. This we have created on a separate sheet, Hari's account, made posting on the debit side to sales account 6,000 amount of the transaction. Next transaction is fourth transaction for furniture purchased, furniture account debit to cash account. We have already made posting into the cash account. Now, posting will be made in furniture account on the debit side. This is furniture account. On the debit side, particulars column to cash account and the amount 5,000. So, I explained you these rules of posting from journal to ledger. Account debited in journal, posting is made into that account on debit side. In the account credited in journal, posting is made on the credit side of that account. After preparing these accounts or posting, these accounts are to be balanced. Balancing of accounts means finding the balance of that account. Difference between the two sides, debit and credit. As we know that the next step is preparing trial balance, in which the balances of different accounts are to be recorded or listed. So, if we have not calculated the balance of these accounts, we cannot prepare the trial balance. Or if we want to know the final outcome of a particular account, for example, we want to know the amount payable to any Mr. XYZ, we must know its balance. So, the balancing is very important. Process of balancing is very easy. We have to make equal both the sides by putting the difference as to or by balance CD on the side which is shorter. So, if the debit side is shorter, then we shall record to balance CD and the amount balancing figure. If the credit side is shorter, then we shall record by balance CD and the difference amount. Here I have used one word, CD. What does it indicate? CD indicates carried down. It means balance has been carried down after preparing this account. For example, if we have closed the books or calculated balance on 31st March, then this balance in this account shall be carried to the next month, which shall be prepared below that March account, that is on 1st April, and that will be there. We have to record the balance is carried forward to the opposite side. If the balancing figure has been calculated on debit side, then it shall be carried on the credit side of the ledger account. If the balancing figure was on the credit side, then the balance shall be carried to the debit side. When we carried it to the next year or next accounting period, we record BD, that is brought down. But if you see the real ledger accounts, so at the end of the page you will not find CD, you will find CF. CF will indicate the carried forward, and in the next page we shall use BF, that is the brought forward. So, we could see if the debit side exceeds the credit, the balance is called a debit balance and carried forward on the debit side on first day of next period. If the credit side exceeds the debit, the balance is called credit balance and carried forward on credit side of first day of the next month. So, this balancing I have explained here with the example. The example which we took, in which we prepared the journal entries and the ledger accounts. So, you see the first account we prepared was Ram's capital account, and in Ram's capital account there was only one transaction, that was the buy cash account on credit side 20,000. So, to calculate the balance we have to make the total. The credit side total is 20,000 and nothing on the debit side. So, balancing figure is 20,000 which we have put on the debit side to balance carried down. Then the total, that is same on the both side, 20,000 each. This balance which we have calculated on the debit side has been carried to the credit side. Now, why it has been carried to the credit side? We have mentioned here brought down, because it is a credit balance. When credit side exceeds the debit side, the balance is known as credit balance. The next account we see the cash account. Here multiple transactions were there. On the debit side there was one transaction to Ram's capital 20,000 receipts. Then two transactions on the credit side, that is also a payment side, because in case of cash debit part comes in, credit part goes out, that is the payments. So, the first payment was made on account of purchase of goods 5,000, second payment was made on account of purchase of furniture, by furniture 5,000. So, if we find the or check the total, on the credit side the total is only 10,000 while on the debit side it is 20,000. So, credit side is shorter by rupees 10,000. So, we have put as a balance on credit side by balance CD, and being a debit balance it has been carried to the debit side on the 1st May to balance brought down. Now, we see the purchase account. There was only one transaction on the debit side to purchases account. So, the total of this account is 5,000 and the balancing figure on the credit side is 5,000. So, this is by balance carried and it has been brought down on 1st May, as you see after total the next period on the debit side, because purchase account has the debit balance. Hari's account. Hari, our debtor, our customer, we sold him goods for rupees 6,000, posting was made on the debit side and there is no any other transaction. So, credit side is shorter by rupees 6,000. So, we have put that as a balance by balance CD and then after total it has been carried on the debit to the debit side on 1st May to balance brought down 6,000. So, we can easily interpret this account also. When there is a debit balance, then it is a personal account, so it means he is our debtor or we need to receive the money from him. Then sales account, one transaction, we sold goods to Hari, posting was made on credit side by Hari's account 6,000. So, this account, the debit side is shorter by 6,000 and the balancing figure is 6,000 on the debit side to balance CD and it has been carried down on the credit side. Then the fourth transaction was furniture purchased. Furniture was purchased for cash. There is a typing error on the debit side it should be to cash account, not to sales account, 5,000. So, there is a debit entry, so credit side is shorter by rupees 5,000. So, the balancing figure is 5,000, that is a debit balance, and it has been carried to the debit side on 1st May. So, with the same example, we have shown how to make posting into the different ledgers and how to calculate the balances or balance the different ledger accounts. As we know, we have studied different types of journal entries. One type which we have discussed, that was simple entry, and we learned how a posting is made from a simple journal entry into the ledger. Another type of entry is compound entries. We know in a simple entry only one account is debited and one account is credited. While in a compound entry, more than one account may be debited or credited, or on the both side multiple accounts debited and multiple accounts credited. Posting from a simple entry was also simple. So, posting from a compound entry may create a little confusion, but I will make it clear with the help of one example. When we make a posting from a compound entry, so basic rules are the same. Posting will be made in all the accounts affected. Accounts those has been debited, posting will be made on debit side. Accounts which has been credited, posting will be made on credit side. But we have to keep in mind only the relevant amount is to be recorded. See this example. Manoj is our debtor for rupees 3,000 and we have received cash received from Manoj rupees 2,900 and discount allowed to him rupees 100. So, the journal entry will be cash account debit 2,900, cash account discount account debit 100, Manoj's account has been credited for 3,000. So, this is a compound entry because two accounts has been debited and one account has been credited. Now, we will see how these should be posted into cash account, discount account and Manoj's account. First, we are seeing this cash account. Cash account has been debited in the journal. So, posting is to be made on the debit side of cash account. The opposite account or the account credited is to Manoj. Although in journal entry the Manoj account is showing 3,000, but only 2,900 belong to cash account. So, we have to record only 2,900 in the cash account while making posting. I have also calculated here balance because there is only one entry. So, credit side is shorter by rupees 2,900. So, the balance is 2,900 and which has been carried to the next month. Now, you see discount account. As you see in journal entry, discount account has been debited rupees 100. So, the posting will be made in the discount account on the debit side. The account credited is Manoj, but only rupees 100 belongs to discount account. So, only 100 rupees is to be recorded here. So, we need to keep in mind that while making posting, the amount should be recorded correctly. This account we have also balanced. So, credit side is shorter by rupees 100 and the balance is rupees 100. Now we see account of Manoj. When we see in journal entry, Manoj account has been credited by rupees 3000, but while on the debit side the two accounts has been debited, cash account and discount account. So both are to be recorded on the credit side of the account of Manoj. By cash rupees 2900 and by discount rupees 100. As mentioned in the entry that Manoj is our debtor for rupees 3000. So it means that there is a debit balance in Manoj account which we have shown here on the debit side to balance brought down 3000. So the total of this account is the same. So in this account there is no balance. So a precaution should be taken for posting into from the compound entry only the relevant amount, like in this cash account only 2900, in discount account only rupees 100 should be recorded. Another type of important entry which is sometimes may be confusing for the new people, that is the opening entry. We have already discussed the opening entry in the previous lecture. Opening entry is passed at the beginning of the year to bring forward the balances of assets, liabilities and capital from the last year. This is called opening entry as we are opening these account in the books of the new accounting period. When capital is not given, we find as a balancing figure assets minus liabilities. In our last lecture, we discussed an example. This example, the following balances appeared in the books of Messrs. Kishan Stores on 1st April 2004. Cash, bank, stock, furniture, debtors, Mr. A, B and C. Loan from Vishal 12,000, creditors 10,500, from Mr. X rupees 4,500 and Mr. Y rupees 6,000. And we have to pass a opening journal entry. You may be remembering that. So this will be the opening entry. All assets account has to be debited. Cash account debit 12,000, bank account debit 8,000, stock account debit 30,000, furniture account debit 8,500. Debtors account we have clubbed here instead of writing X, the different parties A, B, C separately, because the posting will be made into the debtors ledger in separate accounts of Mr. A, B and C. Here we have clubbed this, the debtors list is prepared in real life and the total amount is used in this opening entry, so 29,000. Then the Vishal's loan a liability has to be credited, so to Vishal's loan account. Then to creditors, there are two creditors, Mr. X and Y, X for 4,500, Y for 6,000. We shall prepare in real life a list of creditors and total amount is recorded in opening entry. Then the balancing figure 65,000. So this we passed this entry. Now the question arises how to make posting from opening entry. Because multiple accounts has been debited and multiple accounts has been credited. So while making posting into on the debit side of an account, the name of which account should be recorded. In this opening entry, we use the word in the accounts which have debit balance or while making posting on the debit side to balance brought down. It shows that the balances has been brought down from the previous accounting period. While making posting of this entry on the accounts which has been credited, we have to record on credit side by balance brought down, which shows that the balance has been brought down from previous accounting period. We see this, we have given the two examples of the debit side. If you see in journal entry, cash account has been debited rupees 12,000. So, when we are preparing a cash account, we mentioned here to balance brought down 12,000. Another account debited is the bank account rupees 8,000. When we shall make posting into the bank account, we shall record on the debit side to balance brought down 8,000. Similarly, while making posting into the stock account, we shall record in a stock account debit side to balance brought down 30,000. In furniture account, we shall record to balance brought down 8,500. In debtors account, we shall record, as I told you, that the debtors are the separate, like in this example Mr. A, B and C. So, the posting will be made in A's account, B's account and C's account separately on the debit side. To in A's account to balance brought down 7,000. In B's account to balance brought down 10,000. In C's account to balance brought down 12,000. Now, we see the account which has been credited in this entry. Vishal's loan account, creditors account, capital account. I have shown here Vishal's loan account. This has a credit balance or credited in the journal entry. So, the posting is made on the credit side by balance brought down 12,000. Another account which we have shown here, capital account. Capital account is credited in the journal entry, amount is 65,000. So, the posting has been made on the credit side by balance brought down 65,000. When we see the entry, the creditors account shall be credited on the by 10,500, which we know there are the two creditors X and Y. So, in creditors ledger, posting will be made in the account of Mr. X on credit side by balance brought down rupees 4,500, and in the Y's account on the credit side by balance brought down rupees 6,000. So, this is a way to post to make posting into ledger from an opening entry. So, today we discussed the posting into ledger and their balances. Now, I would like to discuss in brief the interpretation of a ledger account. The interpretation of a ledger account depends upon the nature of account, whether it is personal, real or nominal. As we could check here, the rules of debit credit do not change. Whether we are preparing journal or making posting into ledger. In personal accounts, posting is made on the debit side when the party is the receiver, and posting is made on the credit side when a person is the giver. So, debit balance in a personal account indicates that the person is our debtor as an asset and he or the firm owes money to us. If a personal account is showing credit balance, it means he is our creditor or he is a lender to us, and interpretation is that the firm owes money to him. We could check here from this personal account of Vishal. Vishal here showing a credit balance 12,000. It means the firm owns rupees 12,000 to Mr. Vishal. Firm has to pay rupees 12,000 to Mr. Vishal, which the firm has taken as a loan from him. If we see another account like Manoj. Manoj is in this account is also this account has been cleared. So, after clearing account neither he is a debtor or creditor, but when we check the opening balance it was on debit side 3000. So, debit side balance shows the Manoj is our debtor, or Manoj owes money to 3000 which he paid in the form of cash, later 2900, and we allowed him discount on 100. So, this is the interpretation of the personal account. Now, the interpretation of real account. Real account, we know the rules of debit and credit. Debit what comes in, credit what goes out. So, the posting on debit side in a real account shows the asset has come into the business. Like when we purchase the furniture, we posted on the debit side. So, furniture has come into the firm or the business. If furniture is sold, we shall record it on the credit side. So, the posting on the credit side will indicate that the furniture has gone from the business or the firm. So, debit balance in a asset account shows the firm owes the asset of this value, while it does not have a credit balance, because assets always have a debit balance. In case of nominal account, there are the two, expense and income. Expense, when we incur any expense, we make posting on the debit side. If any expense is decreased, the posting will be made on its credit side, and debit balance in expense account will show the expenses incurred by the firm during that year up to that date, and expense account does not show any credit balance. Income account shows the credit balance, and the normal postings are on credit side when income received, but no on the debit side. So, this we have discussed. In the next class we shall discuss the special purpose books.
I would like to thank sir for this enriching discussion, and thank you friends for watching. Stay tuned and keep watching. Thank you.